You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. Welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope. I hope that's exciting. Volatility Views program. And of course, you can find all of that goodness via the mothership, the flagship, theoptionsinsider.com, as well as, of course, via iTunes, TuneIn, Stitcher, so on and so forth. Of course, also via our mobile app. And if you are available every Friday, noon Central, 1 p.m. Eastern, / whatever time it is in your time zone, wherever you are. We'd love to see you there via Mixlr, MIXLR. You can ask us questions, hit us up, get all the latest, see how the show is made live, and live tweet us during the show, all kinds of fun stuff. So check us out there, as well as, of course, sending questions and comments. We love to hear from you guys. And let's see who's joining me on the old Volatility Views panel. Let's start off. Let's go in order of proximity. I do believe we have the greasiest of meatballs joining us from the global headquarters by way of Riverside. Are you there, Mr. Meatball?
Hey, what's going on, dude? How are you?
I am here as well, and I know we're having some technical difficulties for him joining us from, of course, Russell Rhodes, the head of education over there at the CBOE. Not just a senior instructor anymore, I've been advised, but actually the head of education. Unfortunately, he is actually in Shanghai for the CBOE Risk Management Conference Asia. He was planning on coming on, even though it's 2 a.m. there right now, to give us a nice live rundown of all things breaking from the realm of CBOE RMC Asia, kind of getting a nice flavor for all things VIX in that part of the world. We don't really get a chance to see that. I mean, the most you really hear about Asia and kind of VIX/volatility combined is not even really that Asian. It's the Nifty VIX, and that's kind of got an Asian flair to it, but not really the same thing. And that's the only one that even really trades or has any sort of action behind it. So it's kind of an interesting area and kind of certainly a developing market from a volatility perspective. So I was hoping to get him on. I haven't given up hope, but we can handle, maybe see if we can find some way to circumvent these difficulties as the show keeps going. In the meantime, though, we're going to keep on rolling right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody. Welcome to the Volatility Review. Like the man said, it's a portion of the show where we break down what was moving, what was shaking, what was rocking, what was rolling in the week that was, and indeed still is, from a volatility trading and analysis perspective. Of course, we are streaming it live, like I mentioned, Friday, noon Central here on December 2nd. Hard to believe we're already into the last month of the year. This year has just flown by incredibly, and it has been an incredible couple of weeks. We, of course, have been off since 2 weeks ago, actually. So it's been 2 weeks since you've heard our scintillating voices here on the old Vol Views program. Of course, last week was the big Thanksgiving holiday domestically, followed by that great retail holiday known as Black Friday. And we never want to get in front of your hunting for deals. Plus, I wanted to give everybody a nice day after tryptophan-induced coma. You don't want to hear us on the radio, so nice week off. But we're back, and a lot has happened in those couple of weeks. Of course, the market's still experiencing, kind of coming off it now, but had experienced an extensive post-election, post-Trump, call it what you will, euphoria, a lot of rally, and of course that meant VIX Cash and volatility in general kind of taking it on the chin. In an equity sense, there are commodity vol to speak of, and we'll get to that in a little bit. Right now, as we're streaming and recording the show, things are pretty much mixed. It's the middle of the session here. We're just coming off the heels of the non-farms announcement. If you guys are paying attention, I'm sure listening to this show, you probably are. You know, this one was kind of a bit of already kind of cooked into the books. People are kind of expecting the Fed to kind of do their thing in a couple of weeks anyway. I think the only real wild card coming into today was if this number was somehow just extremely poor, which would maybe give an argument against raising, but that's not what we got. The number was literally in line with expectations, which pretty much just, I think, seals the deal for a Fed raise going forward in a couple of weeks. And the market has been pricing that in already and kind of taken, there wasn't a huge bump from a volatility or from a volume perspective yesterday from the products trading out here in the volatility space. We didn't see maybe the traditional non-farms pop we have in recent months, again, perhaps showing that the market has already kind of factored this number in. But still, as we're coming off of it now, the market's kind of mixed, and VIX Cash kind of trending downward a little bit around 13 3/4 levels. We're still seeing a decent little gap there between the cash and the futures, even though it is narrowing a little bit. Looks like you're about a 2.5 points out, 2 3/4 points actually between the cash and, let's say, a couple months out. Let's go 2 months out, like the Jan future. It's about 16.5 where it's trading right now. So interesting stuff, Mark. A lot to sink our teeth into this week. What was catching your eye this week from a volatility trading and trending perspective?
Well, things trended up a little bit today, this week, and most notably, VVIX caught a little bit of a bid. If VIX is only up a little bit, VVIX caught a huge bid, and but the market doesn't entirely believe it based on the amount of put buying. Now, one thing that was interesting, and I think we're going to get to this a little more, but there was a massive buyer of the VIX December 12th puts. Massive buyer. Bought 50,000, bought 25,000. I mean, I don't know what the open interest on the line is offhand, but it's got to be getting near 200,000 contracts on the December 12th puts. And, when we get a chance, I want to kind of talk about what I think this guy is doing. But there's been a change in VIX behavior in that we're starting to see, at least over the last couple of months, traders see the value in owning puts in that product, and put volume is starting to catch up to call volume. And while call volume, I think, is still going to outpace, I think the days of expecting open interest in calls to be 2-to-1 may be going away, and that may fall toward 1.7 or 1.5. More similar to what you might see in some equities or the S&P 500.
Yeah, that would be a big change for the VIX product because, as we know, it's pretty much all calls all the time. Maybe this week and some recent weeks, indeed, notwithstanding. It's been it's gotten as high as it hovers, I think, around about a two and a half to 1 calls over puts. I think is kind of like its base ratio, but it gets as high as 4, and even beyond that, 5 and plus sometimes. So, but it typically is all calls all the time. If you listen to this show for any extended length of time, listeners, that typically when we do our top strikes and our top trades and the activity that catches our eye from a VIX options perspective, that it's 90% calls out there anyway. It'll be interesting when we get to some of the hot strikes this week, exactly what was lighting it up. And I'll give you a little sneak peek now because I'm looking at it, and we are seeing a lot more puts on the list this week. So perhaps a sign of things to come. We'll get to that activity in a little bit. Mark, we're just touching a little bit on the futures as well. Like I mentioned, things are, I won't call them stabilizing out there, but they seem to be trending in this certain pattern where we have kind of this same kind of bid between a couple of months out in the futures and the cash, and it hasn't really migrated that much over the past week or so. Anything catching your eye out there in the VIX futures and the VIX futures term structure this week?
Yeah, it's really after really months and months and months of steep term structure with that front month future trading at a huge premium to the cash. We've seen it normalize to kind of the way I would normally expect it to trade. Right now, we got about 20 days to expiration. It's trading at about a 1 point premium. That's about what I would be looking for. So I think that things have normalized, and I think that's a really key factor, and maybe points toward the fact that we are paying less attention to the Fed, that fiscal policy is going to matter. And I know that there's some talk about this Italian referendum, but the U.S. markets are not pricing themselves like they're concerned.
Yeah, you're right. They're not pricing like they're concerned about much of anything right now, except maybe this prolonged rally in the equities taking a breather on here going forward. I'm just checking here. It doesn't look like we're going to get Mr. Corner Office today. It seems like the impenetrable internet wall of China is going to be not be our ally, but be our enemy this time. I do appreciate him trying, even though it is pretty late over there, to give us the scoop on all things RMC Asia. I suppose we'll have to save that for another show, which will give us another chance to delve into all of that. So instead, this is usually the portion of the show, Mark, where I would toss to Russell for his Russell's weekly rundown, but you were kind of just doing it, so I think we'll pick up the ball and run with it there. You were talking about kind of the trade du jour on an otherwise fairly light week. I was just looking at the volume numbers again before we kicked off, and VIX ADV, despite the recent spike, is still hovering shy of that 600,000 kind of magical level, right around 585 right now. And even then, it hasn't really been hitting that number pretty much most of the week. It's been about 400,000 contracts, give or take, most days this week, except for Tuesday, actually, which is really like 238,000. So not exactly a huge week to begin with. No million contract days, not even pushing it anywhere close this week. So any sort of unanimity to one trade is going to highlight itself anyway, even in a busy week. But in a week like this, it's going to stand out even more. I'm looking at those DS12 puts as we're talking, Mark, and yeah, you're right. There's close to 200,000 contracts, about 178,000 contracts open right now. It seems like they've taken a break for today, only 200 and change going up today. But walk us through what you were seeing there, and did you guys at Carmen Line, did you decide to piggyback on all that DS12 put love?
I sold them to the guy.
You're like, how are they now?
I'm like, you want these? I'll sell them to you. So it was funny was Monday they went up for 9 cents, and I was pissed because I didn't get any. They went up because they traded them electronically. Then the next day they came in and paid a dime, and I was like, oh, look at that, I made a penny. And then they've been basically dime bid throughout. And so what I have on now is basically a ratio spread 1 by 1.5. The 13-12 put 1 by 1.5 on, and I'm waiting for this guy to come in more, and I'm probably going to hopefully sell him to him at 15 cents if I get the chance. Now, who is this guy? I don't know if you remember this guy, like, a year ago, 2 years ago, he used to do this all the time. there was a guy that would come in and buy 100,000 or 150,000 of like out of the money puts. And Russell had surmised, and we saw the market tend to do this, that was his hedge against his short S&P position. So I think that this guy coming in, or girl, let's be fair, it could be a girl, buying all of these 12 puts, I think he or she is either positioning themselves or setting up for some sort of market pullback and using these puts as a hedge in the event that he or she is wrong. So I actually think that this flow, while initially at onset seems super bearish volatility, may actually be a play on long volatility.
Yeah, there's always something else they have cooking in another wing, right?
Yeah.
That they're trading again, particularly with this kind of size. You're talking almost 200,000 of these bad boys. It would be something if you just put these on naked, apropos of nothing. And that does not seem to be the case. It would be kind of cool if we get we've had our share of 1x2 call traders out here. We've talked a little bit about 1x2. I think we have a listener question about that a little bit later. Maybe we'll get back into 1x2 put spreads in a little bit. But also maybe who knows? Maybe this will be the start of a new, particularly if our friend here is going to keep this trade on and maybe roll it. Maybe this will be a new. It would be nice to see, just for change of pace for our own sanity, it'd be nice to see some size put players come into play in VIX land and trying, because they seem like they've not really found the recipe, but found a good approach via that 1x2 call spread on the call side. Maybe someone is experimenting. Maybe someone will find that secret sauce on the put side as well. And I said we have a listener question about that, so we'll get to that in a little bit. Moving on to what else was lighting it up from a VIX options perspective this week. There, quite frankly, wasn't a heck of a lot. I think everyone is still coming back late from the holidays, as you can see by some of the really anemic volume earlier this week. And it seemed like a lot of people's activity, if they were playing in the market this week, was drawn elsewhere. And we'll get to that in a little bit as well. But what was lighting it up? What are the hot VIX strikes going into today for this week? And our top 10 list. Actually, there are quite a few puts on the list this week, so maybe that is supporting your narrative from earlier there, Mark, that it's the rise of the puts yet again. Number one, though, is still the in the call wing. Mostly, I think, all D's this week in the top 10 list, so no other months sneaking in there, and all D's monthlies actually, not a weekly in there, which is interesting. Number one, the D's 21 is about 281,000. If you know this list in the past, that's a fairly light number, and again, that reflects the fact that we're still kind of rebuilding some of that open interest, a little bit shy of 6 million contracts open out there in VIX options right now, which is not bad, but is not, again, the light volume there would indicate that OI is not going to be huge for a little while. And then number two, the D's 25s, the appropriate December 25s, 237,000 contracts. And then number three, the D's 22s, about 230, then dropping off a little bit again to the D's 20s for number four with 220,000 contracts. Number five is where we find the first put on the list, the D's 13.5 puts. That's a strike that's been active in the past. We've talked to you about that one before. It's also it seems to often be paired with number six here on our list, which is the D's 14 put. The number five with about 192,000, number six with about 185,000. So they're kind of in lockstep. A lot of spreads have been going up between those two strikes, keeping those very much in the conversation. Number seven, the D's 16s. So a little bit more relevant than some of the other strikes we've seen up here of late on the call side anyway, with about 180,000 contracts open there. Dropping down again to about the D's 16 puts, number eight with 175,000. And then number nine, the aforementioned D's 12 puts with about nearly 170,000, 168,000 contracts. Again, this is going into this morning, so it doesn't reflect maybe some late paper going in and other stuff going on today. As of right now, as we're talking, is about 178,000 total open on that strikes. Actually, these are actually from last night, so it hasn't reflected the last bit of paper coming in overnight there. And then or I should say going in before we ran the number. And then number 10, you can't do this list without having the 30s on here somewhere, and they rear their ugly head yet again this week. They've dropped all the way down to the number 10 spot, so I suppose that's something. Of the D's 30s, about 159,000 contracts. Again, just a tick under 6 million open, about 4.2 on the calls, and about 1.8 million on the puts. Anything else, Mark, catching your eye from a broad equity volatility spectrum before we segue over into all things commodity volatility?
Yeah, I think the other key is that we continue to see correlation kind of falling apart. And you can see it via the fact that VXN is trading at such a huge premium to VIX and not much, and RVX and VXN are on top of each other. And those are two indexes that have really been moving around. So we continue to see correlations behave differently than we're used to over the last 8 years. And so there's still some major rotations going through markets right now.
Yeah, that's always been an issue whenever these types of markets evolve is correlation is the big enemy. That's one of the reasons we talked about many times on our advisor show, which will be coming up shortly after this one. Unfortunately, not going to be live. Listeners won't be able to tune in live, but you can tune in after the fact wherever you get your favorite programs here. If you subscribe to our feed, of course, it will come to you automatically wherever you get this fine program. If you haven't checked it out, check it out. We talk about a lot of fun things like correlation on that program. That has been a bit of an issue for a lot of advisors in the space because they've traditionally, a lot of them and asset managers traditionally done, their traditional CAPM type diversification amongst a series of different assets, and they think they're fully diversified. And then, these weird aberrant markets develop and everything, all of a sudden correlations move to one. And suddenly you realize that you're not actually hedged the way you thought you were. Hence, that's why we talk about options a lot on this program, because the S&P put is a good way to avoid that, and the volatility product is also a good way to avoid that as well. Some of the few products out there that when all other things go to one, you can still reliably count on your delta and everything else in your put or your volatility product performing usually as you would expect, which is a nice thing when everything else is going haywire. Speaking of going haywire, let's turn our attention now to the Texas T, the dark stuff here on the commodity spectrum. Of course, crude. What an interesting week for crude. We kind of saw looks like a bunch of different conflicting narratives. Of course, was the big OPEC meeting in the middle of the week, and people were saying, will they, won't they finally make their cut? And it looks like going into I think it was the meeting was on Wednesday. On Tuesday, it seems like the Saudis were kind of having issues, and it seemed like that the deal wasn't going to materialize. And so we saw sell-offs in a lot of different products and in crude as a result. Then on Wednesday, they finally reached a deal. They're going to cut their production by about 1.2 million barrels a day. So they're currently producing about 33.7 million barrels. Going to cut it down to about 32.5. That doesn't sound like a lot, but when you're talking crude, that is a lot. We saw different products surging different amounts in the crude space. A lot of the big major crude products, your WTIs, your Brents, about 15% or so. We saw XLE up about 8 to 10%. We saw USO, up. These are, of course, from their nadir on Tuesday. Not so much if you count Monday through the entire week, but looking at how low they got in their sell-off on Tuesday, we saw very aggressive volume across the board in a lot of these products. Serious volume, a couple of times their ADV in products like XLE and in USO. And of course, out there in all things volatility related, we have seen a nice little movement. First, a trend up this week, as you might imagine, with crude vol really spiking, getting as high as pushing 60, not really hitting 60 in an OIV, OVX, but pushing it about 57 or so, which if you've been following this product for a while, or those indices for a while, is a very, very near-term high. It's been a while since we've touched anything like that. I'll give you a hint, listeners, looking back over the last year or so, the highest we got was in that really rough period for crude back in mid-February, so we got around the 80 level. And so pushing the 60 is saying something, particularly since OIV and OVX have been hovering in the mid to high 30s for the better part of the last few months, and then slowly we're trending into the 40s as you saw a bit of a sell-off in crude, and of course leading into that big day, spiking yet again, then coming off aggressively to the downside. So trading very much like your traditional event volatility or traditional event risk, spiking on the event itself, and then once the event comes to pass, as people mostly expected, then we're seeing this volatility come in. Mark, I know you don't play WTI as much, but I know you like watching USO and maybe a little bit of XLE, and I know you like to watch OIV and OVX. So what are your thoughts on what we've seen on a pretty roller coaster week, not just for the underlying out there in crude, but also from a crude volatility perspective?
Well, I think crude volatility's gotten pretty cheap, and for the third time in several weeks, I'm going to say wildcatters. I think the wildcatters are going to turn shell right back on. So, I've read several analysts basically out saying OPEC's loss is U.S. shale's gain, and I believe it. So I think that I'd be looking to fade this move and really any move in oil above kind of 55 as anything but a trading, an opportunity to trade. I just don't see 75, 80, 90 and the dais anytime soon. But, with volatility here makes me think, hey, maybe this is a good opportunity to set up puts or to set up hedges. We came up with some interesting trade ideas, XLE versus USO in the option block yesterday. So, I think that I think OIV, OVX are probably too cheap.
Well, especially given all that we've seen of late this week and the ability for those markets to rock and move, I might be inclined to agree with you. I was kind of a little bit surprised as I was watching the sell-off there in crude vol coming out of the announcement and thinking, well, maybe, especially given the fact that a lot of people don't really give a lot of credence to these OPEC cuts. They announce these things. There's a lot of lip service done there, but when the rubber meets the road, these countries actually have to do it, and actually you have to have Russia get on board with this and everything else, and they have to actually manifestly hurt themselves in the near term to benefit in the long term. We all know what a difficult to ask that is, and so if they can actually deliver on it, which has been the challenge in the past, we'll see. And so some people are curious about that. If you're interested, of course, in all things crude vol and crude options volatility and crude options volume, stay tuned. In a few hours here on the network, we'll be coming back live with TWIFO this week in futures options, and we will, of course, get all things crude going out there for you really soon. And since we don't have Mr. Russell here to give us our rundown of RMC Asia, that actually works out for you guys. We get a little bit extra time for you guys on the show. So without further ado, let's dive right on into our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody. Welcome to the Volatility Voicemail. Like the man said, this is the portion of the show where you guys get to take the reins and send us your questions, your comments, your insights, all sorts of fun stuff, your pearls of wisdom you'd like to share with us, your tales of woe in the market, whatever it may be, volatility related, hopefully. Here to Volatility Views, no shortage of ways to do just that, of course, like you just said, via social media, Twitter, Facebook, Stock Twits, as well as via the website. It's all baked in there. A lot of you like to use our feedback form. That's all on the website. Of course, it's all in the mobile app as well. You just want to say the hell with it and just shoot us an email, questions@theoptionsinsider.com. The easiest way to do just that. And of course, if you can join us live every Friday, you can, a lot of you guys like to hit us up via the chat there as well. Or you're streaming live, if you want to hit us up via social media anyway. You don't have a Mixler account for whatever reason. A lot of people like to do that as well. So keep those questions coming, like a bunch of our listeners. A lot of people commenting on crude this week, Mark, as you might imagine. We have, what is this comment? This is Kay from Kay Kamra. She says, going back to what we were talking about, or perhaps he, I'm not sure. I shouldn't assume. They say OVX is almost touching its July highs. They say they expect a pullback in OVX and a subsequent pop in the WTI product here, which is interesting because it sounds like, Mark, you're on the opposite end of the spectrum of that in terms of, at least from a vol perspective, you think it's a little bit too cheap here. If I had to weigh one way or the other, if I had to buy or sell crude vol right now, I would definitely lean in your camp as well. What do you have to say here for our friend Kay, who thinks OVX apparently still too high, needs a little bit more of a pullback?
Well, if the email was written a few days ago, he's right. If it was written this morning, he's wrong. That would be my response.
I'll have to check when it came in. I think it came in fairly recently. So yeah, maybe you're right. Maybe it is a timing issue. I'll have to check and see behind the scenes when that came in. But I think it was might have even been this morning. In which case, yeah, maybe they're feeling on the ladder here. Too bad Russell isn't here because Mark Brant commenting, he says he likes selling SPX iron butterflies daily. That's a lot of, it says that reveals vol variance not apparent in the VIX. He says we need an at-the-money VIX. So I guess another vote here, Mark, for some sort of spot VIX type product. We've seen the attempts to replicate that in the past have kind of fallen by the wayside, not really delivered on what they were trying to do, or they've morphed into something else entirely because delivering that spot VIX is such a challenge. I don't know. What do you have to say for yet another call for some sort of spot VIX type trading product?
I think there's room for it. I think that it's a good idea, and I'd be in favor. Closest thing is VXO, which is on the OEX. That's about it.
In case you can't tell, there, Mr. Greasy Meatball playing Mr. Mom today. He's his wife is ill, so he is diligently still doing the show for you guys listeners. But that's why you might hear a little bit of the junior Marks out there and some of the others out there in the background. Let's see what we got here. RealRK, he chimes in the chat room every now and then. He says, speaking of volatility, or as we were talking about bond volatility on the show last week. He says, speaking of that, if you have time, what do you think of bearish put spreads? And I know you like some of these products here, Mark. You like more TLT, but he's talking more on some of the junky end of the spectrum, literally and figuratively. He says, what do you guys think of bearish put spreads on HYG, JNK, or LQD? I know JNK. I'm not familiar. Let me pull up LQD and see exactly what that one is. Oh, that's an investment grade corporate bond fund. He says, with yields increasing, why have the high yield bonds lagged? I assume because of the longer term move more in price because of the lower yields moving more in price with short-term yields. Let me read that again. I assume because of the longer-term move more in price because of the lower yields moving more in price with short-term yield changes. A little bit of a typo there. But I see huge put activity every other day in these high-yield bond funds. So let's pull up some of these things and see if I don't really watch LQD on a daily basis. This name is averaging about 6,300 contracts a day of late. About open interest is about 3.5 to 1 puts over calls. So he is right there. Today's volume is kind of anemic, only about 200-300 contracts. So kind of hard to pay much attention to that one. JNK also trading fairly lightly today. It's been averaging about 4,400 contracts and only 36, going up today. So not exactly a high volume day for these high yield funds. That one also favoring the puts, about 2 to 1 puts over calls in the open interest. The only one that's kind of lighting it up today is HYG. This is the high yield corporate bond ETF from iShares. This one averages about 88,000 contracts a day, so it moves some paper. And today doing 68,000, and he is kind of correct out here as well. About 58,000 of that 58,640, a little bit less than that, is 62 to 1 is in the put side. So maybe there's something to what he's saying here, Mark, that the high yield funds are certainly favoring the downside here, even though it's rallying today up about 0.5%. What about, I don't know, you guys sling any fixed income or high yield products over there at Carmen Line, and what do you think of his thought of some put spreads, some put verticals in any of these high yield type products?
Well, you have to be watching credit. I mean, you have to, but the idea that just because rates move, that high yield corporate debt is going to move is a fallacy. So there's multiple pieces that go into the pricing of high yield debt, especially these ETFs. One, what is the holdings? Two, what was kind of the basis, which is the spread between the bonds held and the 10-year note? What was the basis at onset? What's the basis now? Because there is some hedging activity involved in this. What has changed in terms of the actual overall interest rates in high yield? So these are all moving parts. You can't just say, well, rates are going up, so high yield bonds are going to be worse. What if, rates are, what if there was already a really wide basis set up? And so there's some slack between, the 10-year note and going to from 1.4 to 2.4. One thing I would note is if you look, when we had that big rally in bonds, it's not like HYG made a big move higher. So, the 10-year note got to what, 1.6 or 1.5 at one point a few months back. And it's not like HYG went to the moon. So what we saw was a widening of basis. And now what we're seeing is tightening of basis. So it's not as simple. And it looks like a lot of the activity that we're seeing in terms of the put activity today, at least, looks like a bunch of March puts. And it looks like, some different hedges set up. So yes, over the long haul, do rates going up affect HYG and J&K, and could that push things around? For sure. All right. But where we are right now, I think that we didn't see high yield or even corporate debt move with this last move in the 10-year note. And that would be why it has continued to just kind of sit here. So that's just something to be aware of. A lot of these were entered, a lot of these trades were put on when the 10-year note was maybe between 2.5 and 3. And it's not like this thing went off to the races with interest rates selling off, with bonds being bought and interest rates dropping. So it's just not as cut and dry and simple as it may seem at onset.
I've got another question or comment here, or kind of a comment question from T. Jones. He obviously listened to Option Block yesterday. He says, VX XLE, who knew? That's something we were talking about on the show yesterday when you were talking about how you like to watch that relatively obscure, shall we say. There are more energy VIXs floating around out there. We talk OIV and OVX, but there is a VX XLE, with mouthful of a ticker that it is. He wasn't familiar with it either here, Mr. T. Jones. He says, where are those SIBO guys hiding these indices any more up their sleeves? This would be a good one for Russell. Because he knows all the obscure products and indices that SIBO disseminates on a regular basis. Again, we talk OIV, OVX. Those are kind of the benchmarks for crude and related volatility. But XLE, also, another reason we want to talk about it as much is because it's more of a broad sector ETF. So there's a lot more in it. So the volatility of that broad sector is a little bit different. But still, you're right, it is worth noting and paying attention to, and that is exactly what VX XLE is. And if you've been watching this one over the past few months, it's kind of followed a relatively similar trajectory to OIV and OVX, and that it has spiked, including earlier this week on the 29th, and now is coming off, hit about a high of about nearly 29, about 28.66 before coming off. Today is hovering right around 20.61, so has come off aggressively like a lot of the other crude volatility products that we've seen. Also, like a lot of other crude products, it spiked in that Jan early to mid-Feb period, hitting a high of about 46, 47. Actually, it hit about 48.80 at that time frame. So again, like a lot of those products, it's about half of where it was, even though OIB and OVX have rallied quite a bit. But Mark, you're the guy who kind of threw this into the mix here on Option Block yesterday. So what are your thoughts on VX XLE? It sounds like you watch it. And what are some other obscure CBOE indices that you may keep an eye on? All
right, cool. So there's a ton of indexes put up by the CBOE. A lot of people don't realize it. I think there's like close to 50 or 60 of them. So I'm going to go through the volatility indexes on U.S. stock indexes. We've got VIX, VXN, which is on the NASDAQ, VXO on the OEX, VXD on the Dow Jones Industrial Average, RVX on the Russell 2000, VXST is the short-term VIX, VXV is the mid-term VIX, and VXMT is the 6-month VIX. Then we've got VXEFA, VXEM, VXFXI, VXEWZ. We've got TYVIX, which is on the 10-year note, and SRVIX, which is on SIBO interest rate swap volatility indexes. Then we've got a VIX on oil, gold, silver, the gold miners, and of course the energy sector, VXXLE. There's VIXs on the euro currency, on the yen, on the British pound, and on FXE. There's individual equity indexes, VX AZN on Amazon. There's one on Apple, Goldman, Google, IBM. There's the VIX of VIX, otherwise known as VVIX. And then there's other volatility-related indexes that are not directly VIXs. You've got VAEM, which is the CBOE VIX EEM indicative bid index, the VIX BEEM, which is the CBOE VX EEM. The VIA was the offer and the B was the bid. All sorts of crazy indexes. So there's ICJ and JCJ and KCJ, which are the implied correlation VIXs. There's the VIX tail hedge index, the VIX premium strategy index. I mean, there are, again, they found something that works, and they are inclined to use it and keep using it. So there are a lot of VIX indexes.
Yeah, it's like the Baskin Robbins of volatility.
And Mark, I dropped in your our Skype group page to see all these indexes.
I have
you can look through them yourself.
I have the list. I'm looking at it right now.
Mark will tweet it out. I'm sure.
I just did. It is a daunting list. God love them for still disseminating VXST. Despite the myriad issues that confronted that product, something we talked about on a regular basis, and probably the only show on the planet that did so for quite some time until that much watched but much bemoaned product finally went the way of the dodo in flavor of what they kind of have now, which makes more sense, the actual short-term VIX products themselves rather than a somewhat more obscure index based on CBOE, short-term volatility, and all that fun stuff. All right, going on here to looking at. Oh, great question, by the way, and we will include that link in the show notes, listeners, in case that was too much for you to follow. There are quite a few. You may be surprised. We check in on us every now and then, so we're familiar with a lot of these. But yeah, they may be surprised at how many of these there actually are, including things like the single name VIXs that they announced several years ago. And a lot of people were thinking that was going to be the beginning of a lot more of these, and for whatever reason, they've kind of kept them limited to the Amazons, the Apples, your Goldmans, Googles, and IBMs. That was supposed to be a representative sample. There was supposed to be more, and I think for a variety of reasons, they kind of kept it the way it is. But it would be nice to see more of those listed and perhaps some tradable products on that as well. That would be great. But again, that's probably a conversation for another day, and we'd be going to have Russell here because he can give some of the CBOE perspective on all of that stuff. All right, let's see what else we got here. Comment from Tulip Futures. I think I pulled it just because I like the handle. He says, low for VIX is no signal. A high of VIX is a signal that forces in the world will come and calm things down. Yeah, that's I suppose I can concur with that. That's something we said before, low VIX is, it could stay in these low regimes for quite some time and not really move, not really spike. And then, of course, when it spikes to the upside, it tends not to stay there very long for a variety of reasons. VIX can't survive at an 80 for a protracted period of time. It would mean the tumult in the broad markets and in the world would be so excessive that it would be hard to maintain. So, yes, you are correct in that regards there. Mr. Tulip Futures. All right, and let's keep on rolling into our final segment here, the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball. As the name implies, this is indeed the portion of the program where we attempt to prognosticate on the future of all things volatility. Last show, we had an even more daunting challenge because not only were we predicting or attempting to predict 1 week in the future, we're actually trying to go 2 because there was no show last week. And of course, we had a lot of factors to weigh in there. We had the holiday season and the days off there and how that would impact things. Of course, the continued fallout from the election, as well as, of course, on the day we actually predicted it, the biggest wild card, of course, being non-farms. It's always challenging to do this segment when you're having non-farms coming up because you never know how that is going to play out, how that is going to result, if it's going to be a surprise, you're going to see a little bit more vol injected, or if you're going to see it play out like a traditional event risk where the vol kind of comes off and how aggressively it's going to come off. So there were a lot of things we were weighing. All of that a long way around to saying, it looks like Russell pulling off his second win in a while. He hasn't really, his consecutive buying of vol has not exactly worked out for him this year. But it seems like here in the final couple of weeks of the year, it's actually starting to work out for him. This time, of course, he is not here, so the ghost of Russell will go first. And he will pick, he's been a pretty aggressive buyer of vol, so he's going to be really happy to buy a 21.2 in the VIX next week. All right, the next closest was Mark. You were 12.25, which was right about where I wanted to go, but I let you jump in first. So you got 12.25. What are you feeling for? We're at about 14.25 as we're wrapping up the show here. Listeners, getting a little bit of a bump in VIX Cash actually going at the end of the show. Where are you feeling for this time next week, Mark?
See, and I thought I was the winner because I thought we were just doing last Friday, and we settled 12.34. Oh well, what are you gonna do?
2 weeks, sir. I told you
2
last
weeks.
Week. Last show, whatever.
You told me last week, 2 weeks. All right. I'm gonna say, let's see. Next week will we be through the Fed? No. I'm gonna say right here. I'm gonna say 14.25.
14.25, unchanged. All right.
I'm gonna go unched.
And you're right, we are not through the Fed, so that's going to be the wild card coming up for that. I'm still going to go fading to the downside. I'm going to say I'm not liking, not a ton though. You know, looking at where the futures are pricing in, I should be giving it a little bit more love. But I'm going to go I was touring between 13 to 13.5. I'm going to go the higher end of that spectrum. I'm going to go 13.5. So 13.5 for me, Mr. Ghost of Russell. A nice and aggressive 21.2, and Mark splitting the Goldilocks difference there at 14.25. All right, everybody. That's going to do it for this episode of Volatility Views for this week. But before we go, as always, I want to check back in with my cohorts, my partners in crime. Mr. Russell Rhodes, of course, couldn't make it. So head on over to CBOE.com. Check out what they have cooking over there in the Institute. Chances are they have a class or a webinar coming up that may interest you. And also check out our friends over there at CBOE Live. I want to get them on the show pretty soon so we can detail all the new upgrades that they are putting on for their, because we've been talking about a lot of upgrades to the platform for a while. I want to hear it from the horse's mouth, so we'll get them on. Of course, all the stats we use throughout the show come via that platform. So if you're not trying it, check it out, livevol.com, LIVEVOL.com. You see a button there, a big green button. You can't miss it. Get the free trial. Try it for free. Cost you nothing. If you're listening to this show, I got a feeling you're pretty active as a trader and in the volatility and options space, so you kind of want a nice analytics package. And the one we use day in, day out for every one of our shows, even if they weren't sponsoring, we still be using it, is LiveVol. Check it out, livevol.com. And before we go, Mr. Greasy Meatball, what is cooking in the land of all things Option Pit as well as Carmen Line?
Well, if you're listening to this live right now, our entire store of coursework is 50% off. So if you want to learn about the VIX, our VIX primer is a 4-hour class. It's 50% off. Boot camps, you name it. And then also next Saturday, we have our trading options within a changing interest rate environment, trading options and stocks with the Fed. That's going to be a week from Saturday, so the 10th. You can go to optionpit.com/events to sign up.
All right, everybody. Check it out over there as well as liveball.com. On behalf of the Greasy Meatball and the ghost of Mr. Rhodes, we'll be back from the hinterlands of China sometime in the near future. And indeed, myself, I want to thank all of you out there listening audience for downloading and streaming and subscribing to the show. And, of course, for sending in such great and many and varied questions. Keep those coming. We love to hear from you guys. And we'll see you next time right here on Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.